Let's take the conversation forward. Unmesh Sharma, head of institutional equities at HDFC Securities, is now with us. So let's find out what their house call is. Unmesh, thank you for joining in. Good morning to you. So we'll talk about FY24 in a bit, and I know that you folks are a little below consensus street estimates. Let's talk Q4 first. FY23 was really a saga of earnings downgrades. Is that how the year will end, with more downgrades in Q4 of FY23 as well?
Probably not FY23, but we can, we've been, unfortunately, it's been like this since the second quarter of the year. I think that story, however, has always persisted in the Indian markets. I think if you look at the last, 15 years, only 2 years, we've actually had earnings which rose through the year, not actually declined during the year. So will we see that happen in FY24? Yes. FY23, look, a lot of the operating results are out already. So the earnings estimates have adjusted for that. We are at around 7 or 8% growth for this quarter, which is not that different. So even if the number does come off, it will be like half of 1% or something like that. So FY23, I think, is in the bag. The question really remains FY24. Now, the street estimates, I have seen a range of numbers between 16 and 21%. Let's say the average is around 18%. We are at 12. Okay. So do we see that number for FY24 start to fall from this quarter? Probably not, because there are so many imponderables. People will want to see, investors will want to see what happens in the first quarter and so on and so forth. So from that perspective, we do not see a cut in this quarter maybe, but that is our base case hypothesis for the rest of the year.
Okay, and what will keep driving these earnings cuts? I mean, the narratives are all out there, sticky inflation, monsoon, El Nino, but I just want to get, the biggest risks that you see that perhaps will keep driving earnings downgrades come the first quarter.
Yeah, so look, the worst of the inflation problems seems to be a little bit behind us. So unfortunately, the driver of that downgrade may change a little bit. Last year, what we saw was agri inflation was there. There was not so much, but there was non-agri inflation there. What we are expecting now is that because of the base effect starting to quicken, which is happening for 4Q as well as for the first half, let's say, of next year, the non-agri inflation, which is the larger part of the inflation bucket for earnings, right, is not something which is concerning us so much. But, you would have seen that there are all these concerns on, on the monsoon. If that starts to play out, then we will start to see a little bit of uptick on the agri inflation. Now, that's not the major driver, however, of any downgrades. The real problem, however, comes from two fronts. One is the smaller factor, which is what happens to rural incomes given all of this. But more importantly, the demand scenario continues to remain fairly difficult to predict, because the external environment on the export-oriented sectors will be uncertain. And on top of that, there is this slight issue of inflation. So from the cost side, it may not be driving earnings down as much as probably on the rates and on the headline demand itself.
So if your earnings expectation for FY24 is at 12%, which is much lower than consensus, which stands at 15, 16, even going up to 20%, as you pointed out, and we are staring at the possibility of downgrades, do you think the market returns are capped then? So even if we do see decent numbers this time in Q4, there is no reason to go out and buy stocks right now or sectors that you like.
Okay, so slightly nuanced answer on that. Look, since last August, in fact, including what I've been saying on this channel, is that as numbers come off and the external environment continues to remain uncertain, which is the base case even today, the market's not going to give significant returns. Now, how do you make money in this market, right? So we've got negative returns on the Nifty since that time. So that's, in a sense, good. When the market falls below 17,000, which is what happened recently, it's nice. You can see that value starts to kind of emerge in certain sectors. Now, does that mean that you go out and buy the whole market? The answer is no. What we believe is that you should use this dislocation, and the headline market, even now 17.5, is not that compelling. But certain sectors, there has been, especially in the mid-cap space, there has been quite a bit of correction. So how do you play this? Look, we believe in an uncertain environment, people will give a premium to certainty of earnings, especially where there is some valuation comfort. which brings us back to the safe spaces of the large banks, select IT names. That's broadly how we are seeing it. What we also believe is that in this kind of environment, very high value stocks, even though in the short term, because of lower inflation, the consumer names are looking okay. But we think that going forward, we are going to be underweight on the consumer even now. Okay, so and similarly on the energy, NBFCs and small banks. The other is that where we do have control. Okay, so the government's doing a great job on the economy. So as far as the economy-facing sectors are concerned, where there is not very significant issue on inflation anymore, that's the type of space that we like. So if you look at our model portfolio, you'll see some industrial real estate names in there, power, even some autos in there. And then you have the thematics, right, where none of this matters and you're looking at 3 to 5 years. So financial inclusion, city gas, there are names like that which are in there. That's how we are looking at it.
Okay, so it is time to be very selective and you cannot just go out and buy the market at a time like this. But Unmesh, I want to pick up on the autos that you were just mentioning and ask you a little bit more in detail, because there are several ways to play this pack, right? What do you like within this? Do you look at the standard, passenger vehicle makers? Do you look at the two-wheelers? Are you looking at the EV push? How do you approach the auto pack?
No, I think, on the autos, we have an overweight position on Maruti. What we are doing is that we are not taking a very strong call on... Okay, so look, there has been two factors. One is that because the sowing has been good, so we are seeing some good traction on the tractors. But if you look at passenger vehicles, Maruti is the one where we have an overweight. There is a little bit of a relative value call given, where it sits. On top of that, what we are also seeing is that not taking a complete bet on rural. So it's like sitting somewhere in the middle. Basically, that's the one call that we have taken in the auto space.
Okay, so overweight on Maruti. Unmesh, I heard you say that along with banks, even select IT offers a safe space in the market. That's an interesting, call considering all the concern that's out there. Stocks have anyway underperformed quite a bit. Is that the reason you're looking at IT? And within that, it's a large universe, mid cap, small cap, large cap. What would you go with, considering we'll start hearing from all the companies this evening onwards? Yeah.
So look, on IT, so on the model portfolio, we have an underweight of around 150 bips, if I remember correctly. So we are slightly underweight in that sense, but to a large extent, that's because of a large underweight position in one large name, which is TCS. If you look at our portfolio, we are trying to get relative value through Infi and HCL. Also, when we look at IT in our coverage, we are also including some of the tech type names like the IT and the exchanges also in there. So there are two, benchmark weights that we have on Cyient and MCX. So what we are doing is that we are chasing really probability of earnings delivery more than playing the thematic IT through the space. The concerns obviously are the same as with everyone, is that we have to observe through the year whether this slowdown in the, this effort of the central banks to slow down the global economy has any impact on the demand. But at this point in time, we remain fairly constructive on these individual names, even though the overall space is a bit underweight. So what we'll do is that, look, this quarter is not going to give us too much sense on that, we believe. It's going to be mostly a flattish kind of quarter. And what will happen is that we'll start to look at demand commentary, but we expect that will start to emerge only as we go into the first quarter of the year and not right now.
Point well made. Unmesh, thank you very much for joining in. Look forward to another conversation. Let's just